Just get your reaction to what we've been talking about here: profit recession, the idea that the country is that the country and maybe the global economy is likely to go into a recession by the time the leaves turn color.
Well, if you look at any of the leading indicators, I'll give you three, Tyler, that I've talked to on the show before. Anytime that the yield curve inversions have hit this percentage, 93% of possible yield curves were inverted. And I think we talk about that like it's some kind of like mysterious thing. Why would a lending institution lend money to lose money? When short rates are higher than long rates, that's what happens. So that has always led to a recession. In addition, you've got the Conference Board leading economic indicators you've had a recession each time they've been at the current level. I went back and I looked at any time you've had a soft landing, whether it be 2016-17, 1995-96, or even 1966-67. The Conference Board leading economic indicators were nowhere near where they are today. And then lastly, now everybody's kind of picking up on it. I think I talked to it the last time I was on the show, is that lending standards were tight going into the banking issue, Tyler. The Fed raised rates in a historic way, the fastest tightening cycle in history, into a generationally levered system. Of course it was going to break. Something's going to break. That can't, especially when it's that quick, it can't work that way. So lending standards were already tight, and now they're going to tighten further. So if you put the banking issues up on the shelf behind me and just think about what it means to money, it's hard to use money when you don't have access to it.
Julie, you want to jump in with a question?
Yeah, I was going to ask, are there any red herrings of data that you think investors are paying way too much attention to and that they should be focusing on something else in order to really ascertain which direction the economy is going?
That's a great question, Julie. I think unemployment is the number one focus. Inflation is not the issue anymore. I'm with Karen and everybody else. If you're going to go into recession, looking at inflation is behind us. If you look at the rule that some like, some don't, but it seems to have always worked. It's when you have the 3-month average of unemployment, if it gets to 50 basis points above the cycle low, which means if you average 3.9% over 3 months, you're in a recession. We're great at talking about things like it's past tense because we do historical studies. In real time, that's one of the ways you can see. And also, the initial rate cut, the initial rate cut is typically a sell signal, not a buy signal. They do it because the unemployment rate is rising and credit and financial conditions have tightened. So you're looking for much more than that. And you can see that through a very sharp steepening of the yield curve, not an inversion.
So I want to get your explanation for why you say you expect the S&P to test its October lows by midsummer. And could it go beyond that?
Well, it'd be historically unique from two fronts, Tyler. So the first one is the S&P 500 since 1957, when it became a 500 stock index, has never made the low. When it's down 19% in a cycle, when it's ever been down 19%, it's never made the low, the absolute low of that bear market prior to a peak in the 2-year yield. So that just happened, and I kind of charted, it was literally 2.5 weeks ago. So that would mean it would be the first time that if October is the low that would happen, number one. And number two, if we do go into a recession, again, all the data points in that direction. Now people are kind of jumping on board with that. If you do go into a recession, the S&P 500, again, in the same time frame since 1957, has never made the low before you even enter the recession. So it typically happens about 23 weeks in. So that means that, one way or another, we're going to go back to that October low. And I sound so negative. I know Dan does, and a bunch of us are. And that's what happens at the last push lower. You start out with good news is bad news because it means the Fed's going to be tight. Then bad news is good news. It means the Fed can take their foot off the throat of the market. When bad news becomes bad news, that's that push lower that you want to be in a position to attack. So our framework is to be light and tight. Lighten exposure, in other words, have more cash than you would normally have, but not get too defensively positioned because it's hard to get really aggressive as the market's swooning if you're already betting that way.
So if I hear you right, this last move lower is actually going to be good news. Am I right?
That's the time. That's always the time. We're 1.5 years into this, right? And I heard somebody on the 4 o'clock show say that she's been bearish it gets old to be bearish for a year. You want to get, and that's the hardest time is when you're heading into a recession and the market's swooning, but that's typically the right time.